All right, welcome everybody. We're going to call this meeting to order. We'll start with our roll call. John Vischer, member.
Matt Barker, member.
Pat Keough, member.
Harvey Lewis, member.
David Rader, member.
You guys can go ahead and state your names.
Sure, Bridget Lechtenberg, from principal.
Greg Pittenger, Principal Global Investors.
Greg Williams, staff.
William Johnston, staff.
Brendan Vavrica, Anco Consulting.
Mark Benton, staff.
All right, fantastic. All right, we have an agenda before us. I take a motion to accept the agenda. Do I have a second?
Second.
All right, all in favor, please say aye. Aye. Aye, we have an agenda. All right, we have the minutes from our last meeting. Any additions, deletions, challenges, complaints? If not, we'd be very happy to take a motion to accept the minutes as presented. We have a first motion. Thank you, Harvey. Second. All right, all in favor, please say aye. Aye. Minutes have been approved. All right, let's go ahead. Our friends from principal, you guys have the floor. So as you know, we're a relatively active board. We like to ask a lot of questions. So do you prefer we hold our questions to the end of your presentation, or do you mind if we interrupt as we go along?
Let's make it conversational. Go ahead and ask as we go.
Yeah, that'd be great.
Okay, fantastic. All right, the floor is yours.
Time frame, 20, 30 minutes? What's the time?
Yeah, typically 20 minutes or so,
Perfect.
and then we go longer.
You bringing lunch?
Well, thank you all for having us again here. My name is Greg Pittenger. I'm a relationship manager with Principal Global Investors based in Raleigh, North Carolina, and work with institutional investors like yourselves throughout the Southeast. So, fortunate today to have Bridget Lechtenberg as a portfolio manager on the U.S. property account today. Real quick, I will just touch base on I don't have the deck in front of me here on page 3. Perfect. Just to give you an idea of Principal's real estate platform. As of 12/31, a little over $105 billion in assets under management, a top 10 global real estate manager. One thing I'd point out here on this deck, we call our 4 quadrants. There on the right-hand side, you'll see in that kind of royal blue is what we're going to be talking today about, the private equity piece. It's where our core portfolio is positioned. That's the largest piece of the portfolio. As you see, about $43 billion in clients' assets. What this, I think, is beneficial to you all as clients, and Bridget can elaborate on, is the team gets a in-depth view of what we're doing across both the equity markets, private and public, as well as the debt markets. And I think especially going through COVID, giving Bridget's team a real deep view and be able to sit with the rest of the real estate team to figure out, what deals are happening at what cap rates, how debt's trading, what are the opportunities, where are some of the pitfalls, and I think that brings an expertise to you all that most other of our competitors can't do. So something I just point out on that front. It really gives them some in-depth knowledge that she shares across this platform. So any questions on this page, in the interest of time, happy to answer it across Principal Real Estate, but if not, we'll go into the portfolio. Perfect.
All right. Page 4 is just an outstanding summary of what your value is in U.S. property account. I'll maybe have you directed to page 5. So this is just a reminder of what you all are invested in. The U.S. property account is a core real estate strategy, and we place an equal emphasis on return generation and risk management. And we accomplish that through investment in a high-quality portfolio of properties across the U.S. with really a focus on income growth, in addition to maintaining a relatively low leverage ratio. Our investment objective is to meet or exceed our benchmark, or the NFI Odyssey, as you can see on that final bullet. And I'll refer to those interchangeably as the Odyssey or the benchmark throughout our discussion today. On page 6, so this is a summary of the team in place today. One change to note for you all is at the beginning of March, John Berg transitioned leadership of the U.S. property account to Darren Kleiss and Megan Phillips, who are now co-portfolio managers at the completion of what was a very thoughtful and measured multi-year transition. Darren and Megan are still some of the longest tenured PMs across the Odyssey peer group. They, if you recall, Megan joined in 2006, Darren in 2007, so now weathering and managing the portfolio through both the global financial crisis, most recently through the pandemic. So come out of that with significant experience, and are really the ones who have helped position this portfolio to where it is today. John is obviously still actively involved in strategy through our weekly production meetings. He's also on our senior strategy committee that we meet with quarterly, in addition to still a member of our investment committee. So still very, very active, but just from an outside role. To round out the rest of our team, we've got myself, I joined in 2013, Ross Johnson, who joined in 2018, and then Ellen Bennett, who joined us most recently last summer. A couple of the groups that help us manage this portfolio are listed on this page, and I'll just point out a couple of things. So Indranil Karlekar heads our research and strategy, and that team is really an important piece of our investment strategy, and they're deeply woven in really crafting that with their insight. And I'll give you an example here shortly in a couple of pages on how they impact that strategy and how they're involved in our investment process. The last thing I'll note is the ESG and operations. While we are not an ESG-centric strategy, at Principal we are, have been and are at kind of the leading edge in terms of sustainable investing. While that, like I mentioned, isn't our core mandate here for the U.S. property account, we are mindful of that and do invest where we see an economic benefit, and it upholds our fiduciary duty to you all as investors. I'm going to stop there, see if there's any questions that I can answer before we move on. Okay. Page 7, we provided an overview of some key stats at the end of the year. I mentioned we maintain that relatively low leverage ratio. You can see we ended the year at 21.7%, and that is a little bit below our stated target of 23 to 25%. We did lock rate on some private placement, so some fund level unsecured borrowing that we'll fund here in early April, and that'll bring us back into our 23 to 25% range. Obviously, operations have been challenged over the last couple of years in the midst of a pandemic, and you can see we've been able to maintain really strong occupancy. We ended at 94.7% at year end. And really one of the hallmarks of that is the one-year net absorption of nearly 850,000 square feet over the last year. So this is simply space that's leased today that wasn't leased a year ago, and is just really a true testament of the strength of our asset management team's ability to lease space, particularly in what's been a challenging environment. So not only has that been a pivotal piece of maintaining occupancy, but it's also been a strong driver of, durable income and really growing income within the portfolio.
Richard, I have a quick question on the occupancy.
Yeah.
One thing having a signed lease, another thing actually collecting the rent from the leaseholder. So what type of dilemmas have you had in collecting rents from your various property?
That's a great
leases?
question. Actually, in the midst of the pandemic, that was one of our initial fears as this all kind of rolled out. And we were able to maintain really strong rent collections, even particularly within the retail portfolio. And that stacked up really well relative to the benchmark, who they started gathering that information in April of 2020. So we got to see kind of a side-by-side. So we did very well in terms of that. And you'll be able to see that really in terms of our NOI growth that I'll touch on momentarily too.
Richard,
Good question.
why do you keep the leverage so low? I mean, later on, you're going to see that your debt costs are very low. And it really enhances the returns a lot.
Yeah.
Well, why would you keep it down around 22%?
Yeah, so like I mentioned, we're a little bit below where we'd like to be. I guess as a core mandate, our maximum leverage can be 33%, so we are limited there. We are working to increase that leverage. It is a benefit to obviously property returns. When the returns are higher than your cost of debt, obviously. But we have to be really mindful and really balance risk management with that return generation. So.
Who limits you to 33%?
It's just a part of our investment policy statement. Yeah. So, and if you looked across our peer group, that really is kind of across the board in terms of the other 26 funds in the peer group, but generally we all maintain a fairly low level of leverage.
Richard, if you might just real pat, just for so historically we hired Principal to be sort of a bond proxy. We were concerned about some of the bond returns long run, so their role in the portfolio was a more conservative piece of more income and stability, and so we felt that time when we were sourcing that we wanted a capable manager, but one that was not going to use a lot of leverage. So that I agree with your assessment, but their design was to be the more cautious piece of our overall aggressive portfolio as a fund, so anyways.
And one of the reasons it's lowered a bit is that the performance has just been so strong the last 2 years that that has obviously,
Inflated our
denominator effect, you're
denominator,
gonna
yeah.
have an issue where it's gonna get lower just by, returns are 26%, you're gonna have lower.
Yeah.
Do you have a higher leverage ratio on your value-added product?
We do, yeah. So our value add generally tends to be levered, particularly those developments. Yep.
The relationships on things like that, so you've got your management group, but you have management relationships for each individual asset, because you're spread out all over the country.
We don't have partners on each property across the country. We're limited to 40% joint venture exposure. Today, that's around 30%.
But on something like the value add,
Yeah.
where there's development, are you the developer?
No, we partner with experienced local developers. Yep.
Okay, and is that typically on a fee development relationship? Or?
Yeah, there's a waterfall structure most of the time. Yep.
And that was, that value-add product was something that we had considered when we moved into the core product. But at the time, I think it was mid-2000s when we got into real estate with you guys. And, given what was going on in the markets, we thought it was, prudent to be a little more cautious.
But if you're taking the value add risk, it seems like, given the numbers here, that I'd go with a little bit more leverage first too.
Personally, I would prefer to be in the value add, but, I have a higher risk tolerance than a lot of people.
What's that?
What's the leverage ratio of high risk? Value added.
The value adds in the
Oh,
mid-30s.
sorry.
Yeah, I think it's 36%, somewhere in that ballpark right now. It's under 40, but they target 35 to low 40s, I think.
Do you also go out as far as opportunistic, another fund farther out on the spectrum, or is value add as far as you're going?
No, we do ground up development, and large leasing is included in our non-core value add exposure.
No, I know, but is
Oh,
there
I'm
another
sorry.
fund that's
Yes.
even farther out on sort of like an
We do.
Oh,
opportunistic,
yes, the
which would then be
advanced-
50+% leverage?
Yeah, so we have a
Yes.
value add core plus, which would be in the mid-30s, yeah, and then we have an opportunistic fund, it's that third fund in the series, managed under the same portfolio that, yeah, it targets 50%, it's focused on primarily multifamily and industrial, and it's all development.
Higher octane,
So, yeah. And that is something that we do have, now, Brennan, I think that your team, the research team has talked to them about it, but happy to share further if you want to.
I warned you we'd ask a lot of questions.
No, this is great. I would prefer that you guys are
Great.
engaged and interactive, so this is perfect. The last thing I'll point out on this page is just the contribution Q balance today. That's a little under 207 million. We do have 640 million in documentation right now. If a dollar added to the Q today would take approximately 1/4 to invest. Depending on when those in documentation are added to the queue, that could extend out another quarter. On page 8, these are really the 3 tenets of managing the portfolio. And if you were to look at this page last year or even 2 years ago, you would see these 3 same bullets, but really the execution of those has shifted dependent upon the circumstance. So right now, investment strategy includes investing in that high quality portfolio of properties with good relative value. And that looks like today ground up development, as I mentioned, particularly in industrial and multifamily. We see some good demographic trends and population growth that are really supporting what we call alternative property sectors. So that could mean self-storage, life science, manufactured housing. And that is a component that we have in the portfolio today, but we are looking to grow that exposure over the near term. The second bullet is monitoring and mitigating risk. We kind of talked on the leverage piece of that. We are looking to execute within our non-core allocation. We can invest up to 15% in value add. Of that, 7.5% can be in ground up development. And we've shown you a snapshot on the right-hand side of this page where you can see primarily most of that allocation is in well-leased stabilized properties, but we've got about 6% in non-core. and 3% of that is development. And those are 4 developments underway across industrial and multifamily. The final bullet here is driving operations. We've seen considerable rent growth across the portfolio over the last year, particularly within industrial. And as we look at the in-place rents of our tenants today, those rents are about 16% below where market rates are. So we have a real opportunity to grow income as those tenants roll. On page 9, we've got a diversification map here. So each bubble represents investment within each market, and the size of that dot indicates the level of investment within each. In the colors, the green represents an overweight relative to our benchmark, and that gray is an underweight. So in aggregate, we've got a 9 basis point overweight to the west and the south regions, and a 9 basis point underweight to the Midwest and the east. This positioning is really not new. It's positioning that we've had for quite some time, and really has been built in construct with our research team. As I mentioned, they've been touting what they call a digital framework in terms of market selection. So digital stands for demographics, innovation, technology, I think I said information. Globalization is the other one. But really focusing on those markets where those are really important, and we've been early on to overweight in markets such as Seattle and Austin and Phoenix, and that's really been a strong source of relative outperformance for the portfolio. If we look just at the index returns on a regional basis, the West region in the index had the highest performing return over the last year, and then the Midwest had the lowest, and the range between those was 1,100 basis points. So it just shows you the considerable difference in performance dependent upon location.
Is that research in-house?
No, that would be, oh yes, our in-house research, yes.
So there's an algorithm in-house that's managed to determine what these weights are? Should be.
No, there isn't an algorithm, but more so we really look at market specific. So not necessarily, oh, we need to have an overweight to the West region or an overweight to the South. It's more so, what are the trends that we're seeing in a specific market, and what do we think, what property sectors would best benefit from that or be a good relative investment?
So the research team you saw on that earlier page, which is part of the team, the Bridges team, like kind of leverages, has some demographic views, obviously, within each portfolio, whether it's office, industrial,
Yeah.
multifamily.
Yeah, and their view is really crafted about 75% from internal research and about 25% from external research.
Seattle's still a strong market?
Yes, very.
In town? I was going to say, my sister lives there, just moved out of Seattle.
Yeah, office is a different story. Industrial is blowing and going, performing very well. We've seen really strong rent growth in the Seattle market. But yes, very property sector dependent. All right, so these next 4 pages highlight the 4 primary property sectors, and I'll just kind of summarize those for you, and that's followed by that alternative subsector that I mentioned. So we'll start first with industrial on page 10. This account has had a long-term overweight to the sector, and it's been overweight during a period where industrial has outperformed the broader index for 36 consecutive quarters. So that's been a strong source of relative performance for this account. One thing that's different for this portfolio relative to our benchmark is kind of depicted on the bottom of the page. You can see those 2 pie charts where we're 66% allocated to major distribution hubs. So for instance, that could be Atlanta, Dallas, LA, etc., relative to just 54% for the benchmark. So a good source of differentiation from our peer group. I do want to point out Smithway Commerce Center. You can see is pictured here. That's a property located in Commerce, California. And we've seen significant rent growth in this market. Last year alone, we saw 37% rent growth. And just in the first quarter of 22, we've seen 23% rent growth in market rates. So again, another strong source of potential to grow income within the portfolio as that Ernest Packaging Solutions rolls in a few more years.
And then one other piece would be, that Bridget was in town, flying into Jacksonville, we have some properties
yes.
now in that space as well, on the industrial front, right?
Yep, we have 3 fairly new industrial projects that delivered within the last year. One that's just east of the airport, and then we have 2 buildings that are just east of the intermodal. So really strong location, very high quality properties relative to what's in the market today. So.
Bought or built?
We bought those, actually 2 of them we bought at completion. One was an existing building, but was a fairly recent build.
So it was rented up, or you took the risk of it?
No, actually, one of those, 2 of the buildings were leased. One of the buildings was vacant when we went under contract, and a lease was signed with Natural Life Foods, just prior to closing on that property, so.
And part of the draw, I think, is the port in Jacksonville as well, obviously, that you've seen all the West Coast issues, so I think
Yes.
Jacksonville's managed this issue better than most, so.
Yeah, as other ports have really been overwhelmed, that's kind of been spread to some of the other ports, and Jacksonville's really been the beneficiary of that.
With respect to the areas where you're seeing high rent increases, are you able to take advantage of that? Or, you know, I'm sure it depends on the property and the tenants, but you may have longer term leases which don't necessarily allow you to increase with market rates, but how do you manage that?
Yeah, so that's a great question. Industrial in particular, our average weighted lease term is about 4 years. So some of those, you know, are on the shorter end, some of those are on the longer end. It really depends on the property, like you mentioned, but overall it's about 4 years. Okay, so should we move on to page 11? This is multifamily. We really sold into this strength after the global financial crisis and ended with an intentional underweight to multifamily. And in 2015, we really began to build back into our multifamily portfolio, being mindful of maintaining a diverse cash flow or tenant profile. And that's kind of summarized below on that pie chart. You can see the 4 different components that we have within the portfolio. We've got a component that's affordable or workforce. So affordable is just a city mandated percentage of income, based on income. And then workforce, which is simply just a property that has rents that are, you know, approximate of 33% of area median income. And that really differs by location. We've got some student housing in the portfolio, 4 age-restricted properties with really sticky tenancy. We tend to have really good retention there relative to just traditional multifamily. And then a component that's that renter by choice profile. Today, we like this overweight, and we're going to continue to add to this overweight, really maintaining the diverse tenant profile that I mentioned in key growth markets across the country.
Do you know what the average, the affordable workforce portion, do you know what the average income is for that?
I don't have it across our portfolio, but it really differs by market. For instance, like a Boston where the average median income could be $90,000, you know, that could differ very much so from, say, like a Tampa, Florida. So it really differs, but that's a good question. That's one metric that we don't have handy.
Yeah, I think it's like within 3 miles radius of where we own the property, so it kind of is market dependent.
It'd be interesting to know that. I mean, that you know, looking out into the future, I think that's one of our biggest risks is obviously the consumer and how they can continue to afford to pay for everything.
Yeah,
you know,
absolutely.
Rent being one of them, so.
Yep.
I'm curious, obviously being a university town, the student housing, you have about 11% on that. What kind of broad demographics do you see? Again, just looking at the potential digitalization of higher education and, you know, again, whether, I mean, we're going to keep dragging 60,000 people here to sit around, drink beer, and go to class, you know, for the next 4 or 5 years. I question the efficiency of that model long run.
I'm trying to go back to that.
Pretty darn good.
Now you should check out some of our properties.
Yeah,
Not that I drank any beer during college. But for those who did, like,
I think long-term, I think that's a great question, and I don't have the answer for that. I think during the pandemic, we really saw the impact of that rug kind of being pulled out from underneath us. Occupancy was obviously soft in the 2020-2021 school year as some of those universities decided to go online. A lot of those are back, our occupancy is back, and a lot of those properties, our rents are really back where they were, even ahead of where they were pre-COVID. So right now, from what I see, it doesn't look to be impacting our current portfolio, but I think that's a great question.
In my recollect, last 10 years, there's been a lot of money going into that sector.
Yeah.
So I always get concerned when a lot of capital goes into one spot in a short time frame. How
Yeah,
that
yeah.
changes.
And this isn't new for this portfolio.
Right.
We've been invested in the space since 2006.
Right.
But you have to be very mindful of supply and what's going on in that specific market.
Could you explain, so what would be a decision, as an example, that there's a piece of property either from research strategically said, hey, this is, the tide is flowing away from this particular geographic area or whatever. I mean, when do you make the decision to kind of cut bait?
So we actually had some properties in Tucson, some student housing that we invested in with a partner. I don't have these specific dates, but we saw a huge wave of supply coming online. And we knew that was going to impact occupancy, it was going to impact rents. And so we made the decision to market those properties and get out before that supply came online. So that's just something that our asset management team keeps a really close pulse on in terms of what's happening in the market, what's in the pipeline, what's under development.
Great,
I
thank you.
think that's one of the benefits of having a larger team where you do have access across, again, the debt.
Cross
So
project,
she
yeah.
can share, if a competitor's looking at the debt, like what kind of terms are they getting? Are they going to build?
Yeah.
Do they have the permitting, not, that kind of thing. So that's some of the benefits.
But that partner, they had expertise in that class of property?
Yes, yep.
Local expertise?
That partner was CA Ventures, and they're actually based out of Chicago, but they are one of the larger student housing partners.
And they select you or you select them typically?
Really, it depends. It could be a direct relationship. In that particular instance, from what I recall, that was broadly marketed, and they eventually selected us based upon our experience and our ability to execute and make decisions, and we were strongly aligned with their investment thesis.
But when you say they competed among equity sources?
So they may go to a broker, yeah, and just market it to several equity sources. Yep.
That's where I think you'll see also the size as a scale as a benefit in a bit here as we go to some of the alternative sectors, if you will, where we're partnering with other groups that build specific things like manufactured housing might be it, and making sure that we have those long-term relationships so that we have, I don't want to say dibs, but you have an opportunity. They come to you when they say, I want to do a project in wherever city, then we might be one of the first calls, and that's where you want to be in this space especially.
Yeah, and going back to Greg's point too, just having that cross-quadrant look and perspective, a lot of times we're able to get a deal on a direct basis. If we look back to 2001, I want to say the metric is 60 to 70% of the deals that we've done have been on a direct off-market basis, just due to that network and that relationship that we have across the firm. They could have been a prior borrower of ours at principal or et cetera.
But to structure a deal like that means you need local counsel in Arizona
Correct.
to document.
And they have the expertise in that front traditionally. The partner we're going to have a venture with is traditionally in the student housing space going to have that expertise. I mean, we might have other properties in Tucson or in Phoenix that we have some experience with, but they're going to have the expertise as to what needs to be worked on.
They have their local counsel, we have our local counsel, and they work together to come to an agreement on documentation.
I got another to go with it. Thank you, Pat, for that question. Sparked another couple of thoughts. So just in terms of deal flow and the quality of deal flow, you haven't looked through 20 deals, to find one where a couple of years ago it was 10, and again, given the elevation in the prices of real estate, obviously it's a more expensive asset. So can you give me kind of a perspective on, is it, you got to kick more tires, or tell me how that works?
That's a great question, and as a firm, I think it's like 1,800 or 1,900 deals that our acquisitions team and asset management team is looking through on a yearly basis. So there's a lot of deals that don't even make it to what we call a fact sheet stage, which is just a quick page. Here are the stats, let us know if you're interested. The strike rate is probably pretty low based on that denominator, but yeah, there's a pretty stringent process to kind of weed out, okay, we know Out of our 5 clients internally that the acquisitions team may say, oh, I know there's maybe 3 clients that potentially might be interested in this, or, need some industrial exposure or what have you. And so that's kind of how it filters to this fact sheet stage where they send it out to all of the funds and strategies.
And then within the queue you have, and again, I know there's a lot of private equity money, trying to find a home for yield. Could you explain to your process for saying if there are no attractive properties, and there's always some, but if there's a paucity of opportunities, but there's a lot of people that want to get in because things are going up high, how do you balance that in terms of saying, what type of pressure, what latitude do you have in saying, yeah, I know, you want to invest your, $80 million, but you're going to have to wait and start sitting your CD or whatever they're doing. But can you kind of explain how you manage that?
Let me know if I'm not answering your question correctly, but we do have an internal allocation process that includes, all of the funds that might be interested in a type of transaction. So one is, existing properties by property sector, and the other queue is development by property sector. And so, we all kind of rotate through this queue system, but in general, we've had really good deal flow, and there are very few circumstances where, say, the enhanced property fund gets a deal that we would have liked to have.
Okay, that's my next question, okay.
Yeah, so adequate deal flow is really, really important and has been a great benefit of not having to fight for deals internally.
And also, I think your question, John, though, is around if we don't find an opportunity that we want, and there is cash that wants to come to, we're going to act as fiduciary, obviously, for our existing clients. We're not going to just buy something because we have to buy something.
We ran 2006, 2007.
Yeah.
I'm curious, how are you, give us an example, how are you handling that?
Yeah, and that contribution queue that I mentioned has been in place since June of 2019.
Okay.
And we are very careful about managing our level of cash, because that's a drag on performance, for sure. That cash doesn't generate much income, so. Yep.
Wouldn't you, take that to something,
That.
wouldn't you be competing with student housing REITs for whole deal types of structures?
On the buy side?
Yeah.
Potentially, yeah. We do run up against REITs.
Okay.
Yep.
And it would typically be the specialty REIT or something like that?
That
Yeah,
would focus
sector
on student,
specific, yes. Yep.
Yeah, you definitely have some competition on that front, but I think that's the point that Bridget's making, is that we can get, the joint venture partners who work with us know that we can get the deal done. Once Megan and Darren and Bridget decide we want to do this deal, they have the full power of the firm to say, let's get the deal done and we're going to make it work. I mean, that's I think a little bit of difference, and maybe versus a smaller REIT that's, I understand, specific to that industry. They might have a tougher time pulling the capital together, especially if there's liquidity events, things like that we don't have, I don't think, as a larger fund.
And a lot of times we can purchase all cash too. And I think that sometimes that's not a flexibility that all funds or investors have, so.
Again, just a tenor in general. And back in 2006, 2000, I called it as the dumb doctor group that was coming in with a bunch of money, they were overpaying. How much dumb money do you see, taking deals that you'd be interested in, but like they want too much, and some other idiot comes in and pays too much?
Oh my gosh, industrial. Or industrial today, yes. Like there are investors that are, even some of our competitors that are paying a very ultra low cap rate, so income relative to our value, insanely low. And that's where we, as a firm, know what it costs to build and are very mindful of that cost relative to what it is to purchase a property like that today. And so that's where we see good relative value in those ground-up developments with experienced partners, where we can have kind of a leg up in terms of that investment.
Great. Thank you.
Yeah, you bet. Okay, so let's maybe switch over to office on page 12. Our office exposure peaked at 47% in 2015, and we've really been paring that down through strategic sales since then. We sold about $2.4 billion out of the portfolio, and today we're at 26%. In 2021 alone, we decreased our office allocation 900 basis points, so we've made considerable progress on bringing that down. As a function of that, we've really been realistic in terms of property valuations. Overall, our office portfolio, we've written down 10% since the end of 2019, just based on updated cash flows and more realistic lease-up assumptions based on the current environment. Now, if we look at specifically New York office alone, we've written down our New York assets about 40% since the end of 2019. And if we look at that for a benchmark, they've written it down just 10%. So I'm not saying that that 10% is right or wrong, but we've just been really ahead of the curve and been very mindful of speculative leasing and cash flow assumptions in our portfolio.
40%, right?
In real estate, in New York, like you were talking about,
In New
yeah, so
York.
we've been very
Yeah, but
aggressive on
the
that front.
substance of that article we were talking about before, the Wall Street Journal, it says, nobody wants to office in New York anymore, but everybody wants to house there, wants to live there. And so the trend is really towards looking at office as kind of a value add situation in terms of condo conversions.
Yeah.
Whereas you're not doing any of that?
We're not doing any condo conversions, though we keep a pulse on that. And on one of our buildings on Water Street, it's been a topic of discussion. We've seen other buildings in the area that have done that office to multifamily conversion. I don't think right now that's the best business plan for us, but we're just kind of managing the portfolio or managing the rent roll right now, working to lease up speculative leasing, maybe white boxing a space, kind of getting it in move-in ready condition, because the spaces that are leasing today are kind of move-in ready within the city.
Some office we have though changed, like to medical office, so in Boston, right?
Yes,
Yeah.
we did sell that one, yep.
But
in
take that
last
New
year.
York inventory. Now, some of that you're presumably partnering with other people, other firms. Do you control the deals or do they control the deals typically?
The lease deals?
Yeah. I mean, the ownership.
The ownership.
Oh, the ownership?
We're in control.
We are 100% owner on one of them, and we're a 50% owner on the other. But generally, we maintain majority control in all of our joint venture.
Oh, you
Yeah,
do?
Yeah,
that's part of the
agreements.
deal.
Yep. Yep.
Is Odyssey going to change? I know there's just one of 11 in it, but is that Odyssey, your percentage going to come down?
The 26%, or
No, the 61% the index is.
it's a good question.
Can it ever change it? Because it seems like everybody's getting out the same thing. You think that number will change?
I haven't looked at that specifically pre-COVID to today. I imagine it's maybe decreased a little bit just because we've seen more price pressure on CBD or gateway markets. So this 61 is probably lower than it was, say, 2 years ago. But I think you bring up a good point because this just shows the differentiation in this portfolio. We're focused on overweighting in those key growth markets that I mentioned, like Seattle and Austin and Phoenix. And we've got 38% in those growth markets. The benchmark is only 16. In those gateway markets where we've seen more pressures, such as New York, we've got a 25% allocation and over 60% in the benchmark. So that's been a strong differentiation in performance within this portfolio in particular. One thing I stuttered and I was trying to think of my train of thought, but within New York office, one of our properties, 1370 Avenue of the Americas, we've been tracking physical occupancy, and actually it's been one of the highest within the portfolio. It's got smaller floor plates of 25,000 square feet, leased to legal teams and lawyers and such, and physical occupancy has been 67%, which was just kind of shocking to me in New York. So it really differentiates by the tenant profile in your building.
And typically in the office, do you do any credit tenant net lease deals? Or, I mean, Silver Spring is full of all of these government net lease deals.
That's part of what you're looking for there, yeah.
Yeah. This Summit at Washingtonian is a really interesting property. It's more suburban and it's performing very well. And we have those strong credit tenants in place. What's really interesting about this investment is we have a land parcel that we're looking to develop lab office on with an experienced developer. So we're in the midst of building into that. We're also contemplating, do we transition those two existing office buildings to lab? Because we've seen some of that across the country as well, and that's we're really seeing a lot of good demand from tenants in the life science. So
Dr. Fauci in Silver Spring.
Yeah. Okay, anything else I can answer on office before we move
No,
on?
that's good.
Okay, and let me know if I need to.
Actually, let me add one, on the current allocation, you show percentages. Is that based on the current valuation, on
Yes.
revenue? I mean, so current valuation.
Current valuation,
So,
yep.
so when you said you were at 47% in office, and you wrote down some of those, which again, I understand, was some of that decline from 47 to 26, the fact you wrote down the values, or did you actually kick those properties out? Or sell
Most
them?
of it was strategic sales. So
Okay.
we sold about 2.4 billion since
Okay.
2015. So that's been the bulk of that decrease in allocation.
Okay, thank you.
But I'm guessing the vast majority of new investments have avoided office and have been doing industrial and retail. So
Exactly.
the other side is
Yep,
also.
exactly, yep.
Yeah, so the only thing, look, medical office is the one area in
Yes.
office, if you'll call it that we've seen a strong
And,
demand.
and lab. So the
Yeah.
only, yeah, the only places, to Greg's point, that we would look to increase office would be in that lab and in the medical office, potentially, yeah. So retail, this is a fun one to talk about because we've been underweight since 2015. We have no malls, have never had malls, and this has been a big differentiation relative to our peer group. Again, we've got some pie charts to show you there. We've got almost 80% in neighborhood and community shopping centers, and primarily most of those are grocery anchored, with just 30% of the Odyssey Index in that framework. And then 34% within mall. Again, we don't have any malls, so this has been a strong source of relative outperformance in terms of retail. On page 14.
Can I, sorry,
Yeah, sure.
real quick, on the, you said grocery anchored spaces. Obviously during COVID, I would assume the grocery store did phenomenal, but
Yeah.
the other parcels probably did not.
Mm-hmm.
Did you see, did the grocery stores help you keep up with the overall property because of, I would assume, the growth there? Or how did that?
Yeah, I think the retail or the grocery anchored ones, definitely you got more traffic and just ancillary. You had some more business flow to those smaller shop tenants, but to be blunt, I mean, the shop tenants did struggle a little bit, particularly the service tenants, the dry cleaners, the spas, the restaurants did struggle a bit, but we took a really measured approach on a tenant by tenant basis as, you know, rent relief requests came in and, you know, send us in your financials, let us see, are you getting any PPP dollars, and really worked with them to really keep them in occupancy if we thought they were going to make it through the pandemic, and really kind of building up that durable income.
But you don't do that. Somebody locally, actually, the property management is locally. If there's rent renegotiation and all that sort of thing, it's being done by,
Nope, that's our internal asset management group, yep.
huh.
Yep, so we do have local property managers on site, but essentially the asset management group is charged with those negotiations, lease agreements, et cetera.
Do you have any stats on those ancillary spaces within the grocery anchor, as far as how many you had to kick out, or how many didn't renew, or how many didn't pay their rent, or, you know, stuff like that? Do you have any of that?
Yeah,
And I don't mean it today, but just in general.
Yes, that was one thing I didn't get a chance to refresh myself. I think the rent collection information, I will send that to you
Yeah,
because
that's
it's,
fine. I'd just be interested to see.
yeah, absolutely, yep.
It was better than you'd think, that, we
Well,
had that
that's
same
what I've
fear,
heard.
yeah.
That's what I've heard, you know.
And I don't
know.
want to quote wrong, so I just want to make sure I'm giving you the right numbers.
Yeah, I mean, we deferred rent, to Bridget's point, but there was very few that you had to kick out that closed
Yeah.
doors.
There were less than a handful that filed bankruptcy, very few that actually went
I'm
dark.
pretty familiar with Phillips Edison in that space, which, you know, they had similar, they said that it didn't really impact us at all, you know, I'm like, how did it not, you know?
Yeah.
That's
Yeah.
I'm just interested.
Relative to the benchmark, yeah, the malls are really suffered. Yeah,
Thank you.
yeah, you bet.
Malls are vanishing, aren't they?
I
Where
think,
I grew up, they were everywhere. anyway.
I know,
They've
it's,
been bulldozed, 3 of them.
it's definitely a different state today, for sure. I think those higher quality ones are gonna do okay, but.
Do you see overall across the country malls, I mean, we can talk about locally, but turning into medical? Because that's what we're having happen here in Gainesville.
I even saw, I want to say it was in Schaumburg, Illinois. I don't know if this was a Wall Street Journal article, but they're transitioning retail to industrial. So yes, we're definitely seeing displaced retail being transitioned to medical office.
In
Yeah.
Tallahassee, it's the government agencies that come into the malls that fail. So it kind of depends on what the local,
Vehicles, how much
Market is.
I mean, the insurance company went to Europe, so it went from the tax rolls off the tax roll. And some of the law is gone, I don't know how they work out.
But that seems really labor intensive, renegotiating these, and then would you have local counsel again to structure those leases and that sort of thing?
So we have legal in-house. If we do need to work with external counsel, we do have different relationships that we lean on for that. But in general, most of that is in-house.
And it's the benefits of scale, I think that is part of it. That's the part of the broader, bigger team. We don't want to pay Kirkland & Ellis to do everything, so we'd rather
Yeah.
have an in-house team that can
It's,
negotiate that.
yeah, it's a pretty well-oiled machine. Yep. Okay, so page 14 is just really highlighting that alternative sector exposure that I mentioned. On the prior 4 pages, that's really been nestled within the 4 primary property sectors, and here we've really broken that out. You can see in aggregate, we've got about 10% exposure today. We don't have great insight into what that looks like within the benchmark, but we believe it to be around 5 to 6% today. So I feel like we're on the leading edge of that. And as I mentioned, we are planning to grow that exposure over the near term.
Do you have a maximum that you stop, in terms of the
Not
alternative asset
necessarily
class?
a maximum, it's more of a relative value exercise. If we start to see where returns are not favorable relative to other investments that we're seeing, we will pull back. But I think right now we're targeting about 15%.
Definitely the growth areas, that we're looking at. That's, I think, as to earlier questions of what are malls converting to. I mean, there's other opportunity sets that we're seeing.
On page 15, this is a list of our top 10 properties. I think just given time, I'm not going to cover all of these, obviously, but just would reiterate that this is really representative of the type and the quality of properties in the portfolio. Our largest asset is Sonoran Village. That's located in North Scottsdale, and that's in the Phoenix MSA, which is one of the best performing multifamily markets across the country last year. On page 16, this highlights our outstanding leverage today. If you look at the maturity schedule at the top half of this page, you can see we've got about $480 million of maturities in 2022. $160 million of that was an outstanding balance on our line of credit at the end of the year, and then we're in the process of addressing about $110 million of that. Overall, like you mentioned, the overall cost of debt is very favorable. At 3.04%, you see the bottom left of the page. On a relative basis, that stacks up very well, meaningfully below our, obviously, peer group, which was 3.18%. I mentioned some private placements that we'll fund in April, and the average cost there is 2.95% fixed rate, so we're going to be able to bring that cost of debt, fixed rate debt, down even further and locking that long-term debt in. The terms on that are 10 to 12 years, so.
Is the majority of that floating rate on that line of credit, I would assume?
Yes, yep. And then,
But it floats 10 or 12 years. I mean, the fixed terms are,
Yeah.
okay. Boy, it seemed to me, you want all of that you could get.
I know, but like Greg mentioned, it's been kind of chasing a moving target with valuations. It's a good problem to have. Valuations, outside of office are doing very well, particularly industrial and multifamily, so.
And is that an all-in cost? I mean, is that just the coupon on the debt, or do you somehow or other put in the transaction costs as well?
No, that's all in cost of debt.
Yeah.
Yep. Okay, so let's get to the fun part. So page 17, this is nominal performance. I think it's a little bit more instructive to show you all the relative on page 18. Blue bars here represent USPA total gross portfolio performance relative to our benchmark, and a dark gray, which is the equal weight, and then just for your reference, the light gray is the value weight. You can see really strong relative performance over the fourth quarter, the 1, 3, 5, 10 since inception time period. A component of that has really been driven by that focus on income growth, and we've broken that component out below the bar chart there. You can see we've outperformed from an income return perspective over the 1, 3, 5, and 10-year period.
I think that hits your earlier point, John, of why you originally hired us, obviously the consistency on the income piece of this.
Yeah, and on a relative basis, that stacks up really well. We've got some detail behind that income piece on page 19 and 20. So on 19, the left-hand side, those gray bars show you the actual year-over-year NOI growth for the portfolio. Over that 10-year time period, that annual average has been 5.7% for the account relative to just 3% for the benchmark. So pretty considerable differentiation there. As we look forward to the next 3 calendar years, you can see we're forecasting 9.3% in 22 and then significant growth beyond that. The next page, I think, is really helpful in kind of describing where that's coming from. The bar chart on the left shows you, and this is the same information as the prior page, just in dollar terms. So on the left page, you can see we're forecasting growth of $190 million from actuals in 21 through the end of 2024. And on the right-hand side, we've broken that down into 2 components. So we've got operating, well-leased, stabilized properties on the top, contributing almost $107 million. And on the bottom right, those non-core development and leasing assets contributing a substantial amount. As we look across the list of the top contributors there, I see industrial, I see multifamily. And as we mentioned, those are both sectors that are well positioned to continue to see rent growth and demand over the near term. Page 21 just simply summarizes everything that we've talked about today, but I encourage you to ask any additional questions if you have any, and sincerely appreciate an interactive dialogue today.
So certainly 2 years ago this time, the big concern was the office apocalypse. No one was ever going to go back to the office, all rents are going to zero and that kind of a thing. I know it's only 2 years later.
Yep.
Kind of what have you, I guess relative to your lease rolls, what have you seen the last, say, 12 months in terms of tenants that are, leasing less space, they're leasing more because they want more square footage per person? And kind of what are your expectations for the next couple of years?
Yeah, so I think just starting broadly as a firm, we believe there'll be a contraction in need for space of 10 to 15% in general. Specifically within the account, what we've seen primarily is tenants maybe doing shorter renewals rather than locking in long-term, as they just kind of figure out what space they need, who's coming back to the office, how much. Do we need to spread people out? And so that still is yet to play out a little bit, I think, across the country in our portfolio as well. But I think Google at our 500 West 2nd Street asset in Austin has announced that their tenant or their employees are to come back early April. I think several other larger corporations have kind of signified the same. So I think it's going to be interesting to see how this progresses, particularly over the next 6 or so months, barring, another type of variation in COVID.
Interestingly enough, I've seen a lot of folks who have been working from home who are dying to get back in an office. Which is, I've always been in an office, so I guess I don't know the other side of that, but it's just been interesting to see that.
Yeah.
And I have a friend who's worked from home forever, and he's like, I've got to rent space. I've got to go to work somewhere.
And I think what companies are finding is it's hard to maintain a culture and networking and really build those internal relationships that you don't realize are as important as they really are. So
it's really important for younger folks too. I think that don't get any mentoring. That traditionally, in any kind of industry where you need some mentoring, you need some hands-on experience. Trying to do it by Zoom is difficult.
Hiring a new employee that you've never seen in person.
Something like 80% of the employees have never met their new bosses.
Yeah, which is just
that can't be permanent. That doesn't make sense.
That's not going to last 2 years.
They're not going to grow. So that's
somewhere in here I saw a turn. It seemed like 2 to 10 years.
Yeah, and that's just kind of our stated hold period is generally 2 to 10 years. It's-
Why would you do that? I mean, considering how inefficient the, transactions in real estate are, and how
It's-
expensive they are.
I would caveat that with it's very asset specific. So maybe there's a tactical investment where we can get in and it's a leased up play where maybe the project just delivers at shell completion, an industrial building. We take that on, lease it, and then maybe had plans to sell it once it's stabilized. We wouldn't do that today because we want to hold industrial, but just to give you an example of more of a tactical play where we might just hold something for 2 years. But in general, we're longer term holders.
Yeah, because one of the advantages of real estate, I mean, except at the low leverage, would be to periodically refinance and withdraw capital. But that's a function of longer term. I mean, if you've got a quality property, is there much reason to sell?
But not in this market right now, yeah, that's.
Yeah, our kind of churn rate is fairly low. It's definitely below 10%.
Now, on the
basis.
transactions, does principal earn any fees?
No, you mean by representing ourselves like a brokerage?
Yeah.
No.
Nothing. Yeah.
No,
But that's why we would rather have it internal than to paying an outside vendor to do
Yep.
some of that.
Mr. Rader, do you have any questions?
No.
Okay, thank you.
I'm amazed at some of this. I thought things were just gonna go to hell in a handbasket.
well, we sincerely appreciate all of the time that you've given us today.
No, I appreciate your accepting our banter back and forth. It's always, you guys do a great job, so thank you very much.
Thank you.
Well, we appreciate your business, and if you do want to discuss it all, one thing I would mention, and I've sent this to Brennan and Enco knows, the value add or core plus piece of another portfolio that we have. We do have advantages to investors who invest in both the core and the core plus. The fees are added, the assets are added together, so you get a cheaper fee, if you will. So, and then an opportunistic side, if that is something of interest later.
If you want, before you just each leave your card, I'd like to each your card first. I don't think I have your.
I didn't get that. How do you improve the fee structure?
So we have some investors, let's say you guys have $30 million approximately in this, if you had put another $20 million into our core plus or our value add fund, then the assets, no matter if it's 20 and 20 or 25 and 25, you're gonna get the $50 million rate. So you're gonna get a cheaper fee for both, even though you'd have less in each. That's just an advantage. But the open-ended funds that we have, both in the core space and then also in the core plus.
And typically, the returns on the value add, they're a little riskier, but they're...
Correct. You're gonna have a little more leverage and they're gonna do much more development. So I think their limit is 25 or 30%.
Yep, I think that's
So yeah, they're doing a lot more multifamily and retail in that space, in some of the not core markets, if you will, some growth areas.
But sort of a lock-in involved in it.
It's similar to this fund, it's an open-ended structure. So we do have an opportunistic fund that is a closed-end structure, but the open-end structure, we have a lot of clients that are looking, they're saying, we like core, but we also see some of the benefits of doing some build-outs right now, and so we want to take a little bit and do that. And so we want to make sure clients have that opportunity to do both.
Especially given kind of the compression in cap rates, to say, the upside in core is going to be more challenged. So if we still want to try to get, some of that absolute return on real estate, that there might be more opportunity in the value add as you go out on the spectrum. But again, as you look at the plan, your allocation was really more of an income proxy, which is, again, focused on the core space because the primary source is that 4+% income.
Do you have a sort of a stable of developers that you go to?
Or they come to us, yes, definitely.
Yeah.
Okay, with opportunities, but I mean, if you found the opportunity, you'd have a developer, a national developer that you could deploy to.
So there's a couple of examples of that. So the Summit at Washingtonian building that I mentioned in Gaithersburg, so we own that property, wholly owned. We sought out an experienced developer in the lab life science space who we will partner with on a fee basis to help us complete that development. So there are cases where we do seek out someone with expertise to help us accomplish that business plan.
And that's where I think the long-term partnerships that Bridget mentions, we want to be one of the first calls when they have another opportunity. Let's say that they're like, okay, we like this area and our research team like the area as well. It makes sense. And that's where we want to make sure we're one of the first calls in those opportunities.
Do you have an idea of what the overlap is between the core and the value add portfolios or properties?
Regionally, you mean, or?
Shared ownership or, partial ownership within
We
buildings?
don't,
None.
No,
yeah,
no
we
other-
don't invest,
They
yeah.
might look at the same opportunities.
Yeah, we
but-
don't co-invest with other principal
Correct.
managed funds.
Okay.
Yep,
And you don't compete with each other.
Correct.
right.
Yeah, don't sell to each other, that kind of thing. We have to make
Not
sure
bidding
there's
more back and
there's a
forth between
wall.
the two funds.
Yeah. I mean, you definitely, once in a while, will see the same opportunity set,
Mhm.
but again, they're gonna look a little more opportunistically. They're gonna be doing a lot more building than buying, especially in this
Yep.
environment. So it's something just to think about if you are all interested. We're happy to share more information. Thank you all again for the
Yeah,
time. though.
thank
We
you,
really
and we'll
appreciate
follow
it.
up with your 2 questions as well.
Yes.
Thank you. Very much.
Yeah, thank you.
Pleasure to meet you, Bill.
Bridget, you have one as well?
I actually forgot them, sorry.
That's okay, that's right.
Greg knows how to get one.
I think I can get a hold of you.
Yeah, if you send emails to me, I can distribute everything that.
Perfect.
I know, it's one of the hazards of switching your bag for travel. Sometimes you forget things in another bag. Thank you all
yes.
so much, nice to meet you all.
Hopefully the rain's done when you guys are done here.
Yeah, I'm sure the sun is shining when we step outside. Thank you.
Thank you.
All right.
Is there a restroom
Can we
going way
talk
out?
about that?
It might come right down there.
Talk about what?
This, a little bit, or how do you do that?
On the,
The overall relationship.
well, we can talk about it right now if you have any.
Yeah.
what-
Why would we, I mean, there are the assets going out the door every day, it seems to me. Why, has anybody modeled this form of investment against a portfolio of REITs, for example, that specialize in the individual asset classes?
I don't think we have. I think we wanted to buy, well, partly we're a bit constrained, given the asset size that we would allocate to here, trying to get quality firms, at an asset threshold that want to take our money.
And that was
So-
how long ago, John?
Well, see,
2005, you hired them.
5 years ago?
2005.
2005, okay, yes, it's been a
But
while.
at that time, did you consider just a portfolio of REITs?
We did not, no, at that time we did not. At that, I forget who was our consultant at the time, I think it was maybe Summit out of St.
Summit.
Louis. And we were embarking on some bond alternatives, so we were a little early on that, but all the same.
Let me jump into that conversation because this is something that I was discussing with clients at that same time. So if you, sector-specific REITs, obviously the performance profile can be a little different, but if you take a diversified sort of core REIT offering and you compare that against an LP vehicle like Principal, over 15 or 20 years, the return's the same. But you have a very different risk and return profile because REITs are traded daily on the stock market, on the exchange. You are taking, and so back up a second, if we're taking fixed income dollars and we want to diversify it, we got low rates, we want to add some income, you're going from roughly a 4 or 5% standard deviation. If you go to REIT, you're going to 16, 17% standard deviation, which is the same as equity, your small cap equity. But you could go into the private LP type vehicle like this with quarterly, liquidity and so on, and go from a 4% standard deviation to about a 7% standard deviation, and get the same, over time, you get the same return profile. And so I think that was the biggest part of the discussion to say, if we're taking our lowest risk asset and trying to add income to it, if we're going to get the same return either way, we don't want to put equity volatility on it. We want to just move one step up, and that's sort of this vehicle. Now, again, if you want, getting into the nuance as well, we think there's going to be a better opportunity, industrial, multifamily, and maybe we want to, narrow in the focus of the that gets to be a little bit of a different discussion. But just from a high level risk and return perspective, that's why most public pension funds, and also when you consider just the volatility to the sponsor, the more the assets go up and down, the greater the funding volatility on it, when your annual valuation is done. Mm-hmm. So most public funds have opted for the LP type structure Because again, over time, we think the returns are the same. It's just the pricing volatility along the way that's the primary difference.
I don't know.
And Principal actually offers daily liquidity on this fund
Does it?
until markets lock up.
It just seems like so much is dependent on individuals here.
Well,
And
but-
the transactions seem, potentially so inefficient. that,
If you go to the REIT space, if somebody's got to manage that portfolio of REITs, who's going to do that?
Well, you end up with a portfolio of various ones.
Yeah,
and
but
you
who's
get
going to decide what
liquidity.
sector it's in?
But if you're getting liquidity here, then,
Well, the same argument back then without applied today for bonds. I mean, is there,
Certainly, I mean,
would you be
again,
better, I guess the question is, would you be better off right now, forget about bonds, or the way the treasury's keeping rates down, to go into real estate a little heavier as a substitute?
that's certainly one of the things you've seen in particular in 2021. That's why the returns are north of 20%. It is part just because of asset performance, but the inflation discussion, inflation obviously impacts real assets, so you had a huge component there, along with their increased rent growth and all of that. Aside also from the delayed recovery of COVID, because of the way these products are structured. Again, it takes 3, 6 to 9 months to kind of work through pricing. So when COVID happened in February and March of 2020, this portfolio didn't drop that quarter. You started to see some negative returns in the later part of the second quarter and into the third and fourth quarter of 21. The stock market had already started to recover, and these portfolios didn't really start to recover until into I was talking about late 20. These portfolios started to actually recover into early 21 and through 21. So again, a little bit of
Did a lot of them rewrite leases to extend them?
There were some. I'm not sure it's fair to say a lot, but there definitely was some. Certainly the funds that had more retail exposure were more active in that particular area, because certainly in a stress situation, they don't want to be kicking tenants out, because who's going to come sign the new lease? They wanted to keep folks in. They did a lot of...
So if they had there are 2 years left, they extended to 5 or something.
Correct.
It made it worth their while to do so.
And that was less of an issue of principle. Some of the other funds that we saw were being less aggressive, so they were deferring rent and not taking write-downs. Some of the funds were just actually taking write-downs against uncollected rent very quickly. So their performance, when you were comparing to their peers, a lot of their performance in those early parts of COVID were negative. But they're saying, look, we don't know what the situation is going to be. We're just going to go ahead and take the write-down now. If they actually pay the rent, we'll just add it back later. But it created some interesting discussions, and again, just some nuances kind of in these sort of private vehicles, the way they can decide to proactively take some write-downs or just defer it and hope that they get the rent and ultimately take the loss later if indeed those things.
well, what's
don't
the
go.
oversight on the asset valuations?
They have an independent third party that they have to hire in order to do the valuation, so they don't do the valuations themselves.
So it's periodically?
Correct.
Yeah.
At a minimum, each property has to be valued every 12 months.
Uh-huh.
Oftentimes, internally, the funds will do it more often than that, but sort of by the baseline of that space, at a minimum, it has to be once every 12 months.
And that 12-month that valuation is derived by the third party?
Correct.
And not the internal team. So the internal might be adjusting the interim, but ultimately, the ultimate valuation comes from the third party.
Correct. And because they have to true it up.
Sure,
Obviously,
right, yeah.
in the middle, they might adjust up or down, but, and typically how it works is, call it 25% of the portfolio is being done by the third party every quarter. They don't do nothing for 9 months and then have the third party do all of it in one quarter. They're 25% of it's being done each quarter, so then over the course of the year, the entire portfolio is being done.
That's another cost. Yeah, it's just, when you think about the costs associated with managing that portfolio, it just seems extraordinary.
Well, what is the expense ratio overall in there?
It's right at 1%,
What?
I believe.
Yes, sure.
1%.
Yeah.
most of these funds are somewhere between 1 and 1.25%. So your first 10 million is 1.1, then the next 15 million is at 1, above 25 up to 100 is at 95. So that's kind of what he was referring to, is if you add another piece, it's all coming in at that next tier. You don't start over at 0, even though it's a different product. Sorry?
We're already at the top tier.
Yeah, well, I mean, if you get over 750 million, it drops to 73. Well, we have a little ways to go.
Who's got the insurance policy on Bridget?
I've seen a number of the managers as time, I mean, I've been impressed. They've done a good job over time. I would say in a less liquid and rational market than real estate, having some local intel will give you some value add, which they've demonstrated. One might ask the S&P 500, although I still think there's value add by actually having some quality screens. But I think it's a more efficient market. I guess I'm willing to, personally, professionally, I'm willing to pay a little bit more for skilled management in a less efficient market. They have a better opportunity to drive, some output.
It's a very entrepreneurial approach.
Yeah.
When you consider but that really makes you dependent on kind of limited talent.
Well, amongst the peer group, though, that is actually fairly common. Of the 26, 28 funds in the Odyssey, that's how they all operate. It might not have, as many offices, Principal does. They might have a few more people in different places, but that's how all of those core Odyssey managers operate.
Any of those have an international aspect to them?
Not in the Odyssey.
Okay.
You're kind of leaving that benchmark and going into something else at that point.
Great. Thank you. All right. Ernie, you're next on the hit parade here.
Well, I am going to attempt to be incredibly brief, because
Okay.
this is, again, somewhat dated already. This is the February update that you have. We last met late February. I believe that was the day that Russia rolled into Ukraine.
Yeah,
so
that was,
certainly
yeah.
the market has been dominated by that. A lot of February's performance was continued to be impacted by interest rates, even though you have very little direct exposure to fixed income. Still, the worry about interest rates, the Fed raising, which ultimately they did last week, certainly was an overhang, and then that, of course, led into Russia rolling into Ukraine, and obviously all of the difficulties there. So what you see here in this book, again, is sort of continued negative performance for the month. We're down about 2%. On a quarter basis, down about 6.4%. You flip to the next page. Actually, just interestingly, some of the managers that have been struggling recently have kind of turned the corner a little bit. Twin in particular, we've actually been talking about them for a few months, but they're 84 basis points ahead for the 2-month period year to date, and for the last 12 months ahead by about 2.6. Still underwater since inception, but certainly headed in the right direction. Also some relative outperformance out of Barrow Hanley, as well as Pzena and DGI on a quarter-to-date basis. Again, the 2 quarters combined, but of course what you will see are some negative numbers. Interestingly, look at the difference. Barrow Hanley's index there for quarter-to-date is down 3.4 versus Brown, the benchmark is down 12.4.
Yep.
So you're starting to see some huge performance difference, value over growth. So again, in 2021, really, we did see kind of value outperform, but that's even being exaggerated here these last couple of months. In particular, as interest rates move up, the discounting of those growth future cash flows becomes, it's under more pressure. And then, of course, kind of the financial aspect of the value sectors also tend to benefit from higher rates. So continue to see that rotation. In international, Silchester did well on a relative basis. But Bailey Gifford continued to struggle. Obviously, kind of horrendous relative performance over the last 1 year, down 26%. But notice the 3-year, still annualizing 2.2% ahead of the benchmark when you include that last 12 months. Yeah. So it really gives you an indication of how far ahead they were. And a lot of that has gotten taken away. Certainly in the growthier part of the international markets, with the Russia fears in particular, that's caused a lot of volatility in that particular space. And I think also it is sort of bleeding into concerns about China. As Russia goes into Ukraine, some people say, okay, now does China say, hey, let's go to Taiwan? Wow.
What's his name's firing missiles off?
And so again, all of that to say, not that we're predicting any specific thing, but that just adds to the fear in those international markets when you have all of that happening. And so certainly seeing some extra volatility.
Well, for the Bailey Gifford, I think challenge can be directly attributed to the fact, I forget whether it was Forbes or Fortune, they're the featured manager, and so they had the Fortune curse, which almost immediately thereafter
Right.
the issue. So it's I don't know where you have that in your analytics. But
I don't, but it should be in the IPS, that if any manager gets featured on the front page of anything, you just immediately reduce the
Right.
income.
Okay.
Fixed income, you can see down with Loomis, negative as interest rates moved higher. Quarter to date, they're slightly ahead, but they're always going to be very close to the benchmark. Again, keeping that exposure at a minimum certainly is benefiting the plan as we see those negative results. And then principal, who you just heard from, one thing, we don't have Odyssey results on a monthly basis, but we do have portfolio results. So you see a 0 for the month and the quarter. It's not really a 0, but we just won't know what it is until the end. But certainly another 4% in the last 2 months is fantastic. A lot of managers after last year were saying, as great as 2021 was, expect something more like 8 to 10 next year. Well, if we're already printing 4 after 2 months, you're off to a very good start and perhaps, a little bit above expectation. I'm happy to go through this more, but the reality is markets have somewhat settled out here. We're almost to the end of March, so things are actually a bit better than what you see here as of today. But I did just kind of want to circle around with you because of the Russian discussion, invasion, all of this. Have reached out to managers, and most importantly, William, I don't know if you want to cue up the discussion, but directly with both with Silchester and Bailey Gifford, and John, I'm sorry,
Go ahead.
spoke yesterday. We do not have any direct exposure to Russia or other sanctioned Eastern European holdings within the portfolio. So that's the good news in terms of direct holdings. Of course, again, I talked about sort of the ancillary effect and just all of that volatility certainly impacting the portfolios. But in terms of direct exposure, we do not have any of that. So that's certainly good news. And I guess I'll just sort of pause maybe and let William jump in now with the discussion about your city council and some of that.
Before we get on, I can ask a quick question. Do you have an overall sector breakdown of the total portfolio? I know we get it from time to time from each manager, but I'm saying, do you have a global view of sector breakdown? Specifically looking for things like agriculture and oil and gas and things that are
those
really
sectors
outperforming right now.
Brendan, they actually help us with our notes to the financials with sector breakdowns.
Certainly, like at the end of the year, we run those reports, but I'm looking to see if in sort of the regular quarterlies.
I don't think that, hold up the meeting looking for that, but I'd be interested to see that information.
I don't think in the quarterlies we aggregate that.
Okay. That's something you can follow up with.
Yeah, absolutely.
I can send you the September 30 numbers, but those were going to be 6 months old at this point. We have to put those in the notes to the financials that we issue, and there's also sort of there's a sector breakdown, and then there's a risk assessment. It's GASB requirements that we have to meet.
And actually, so I'm sorry, we do have it. So if you were to have your 1231 book, you go to page 29.
Okay, I have it.
Just it gives the sector breakdown for the total, or the equity component at least of the portfolio. It also does the same thing in international. You can kind of see the aggregate, and then later you can get into the individual portfolio managers.
Okay, I'll look it up. Sure. Great, thank you.
William, you want to talk about the...
Sure. So I included the unsigned version of the resolution that the City Commission adopted or approved last week. And so they had brought this issue up in a February, it may have been March, in an earlier March meeting of their finance subcommittee. And so I guess they worked with the city attorney to draft this, although I think some of the language is a little bit problematic. They reference city funds, and I think
technically speaking, I don't think that the pension plan assets would be considered city funds, but, they meant one thing but said another. In any event, there were a couple of commissioners, in particular, I think Commissioner Hayes Santos wanted to promote this idea, and so they went about it this way. And really, there are two requests that they're making to it's a little bit odd because they're making the request as the city commission to the board of trustees for the pension plan, and they are the board of trustees, but it's sort of a bureaucratic way to go about doing it. And they're requesting two things. One, that, the board direct the plan to divest of all Russian and Belarusian securities. And by that, they mean companies headquartered in Russia and Belarus, which, it itself is almost meaningless because there are plenty of US-based companies who are doing more business in Russia than Russian companies are. So, but all that aside, they're making the request to do that, which is really a moot point because the plan doesn't currently have any holdings. Having said that, Bailey Gifford or Silchester could go out and decide to purchase. Although my understanding is, as of today, they've partially opened the Russian markets, but they're restricting foreign traders. So, at some point, our international managers would be able to purchase or sell securities again. The second request, which I really don't think is necessary, and I would advise against the board against doing that, but they're going to do what they want to do regardless of my advice. They always do. I don't think it's necessary to change an investment policy statement for what is a temporary situation. At some point, the Russian situation is going to change, whether it's through a negotiated settlement or a regime change or something like that. And at that point, if you make a change now to the policy, you just have to go back and reverse it. And I'd rather not go through all that. I'd rather just, tell our international managers that we'd rather them not purchase securities. The problem with Bailey Gifford and Silchester is they're both commingled funds, and so regardless of what they say, they're gonna, they have their own policies related to those funds, and I would sort of think that a lot of their clients would take this approach and would prefer that they not own Russian or Belarusian securities, but they, to my knowledge, they could still purchase them when the markets allow. I'm not sure that it would be part of their, their investment decision process would lead them to those securities, but you never know. So the issue is, well, would we have to get out of those funds? What the language I would like to have seen in the resolution would have been no direct investments, and thereby, if we owned commingled funds, those aren't direct investments, and we could have gotten away with that. And, I don't know, I'll probably discuss it with Mark, and maybe we can make that recommendation at the motion that they're going to make on in a couple weeks.
If it's at all helpful.
I think that you can do that. I think that this language was drafted at the specific direction of the city commission. They were purposeful, and Commissioner Hayes Santos was purposeful in his intent to draft it this way. I certainly think that you make the argument at the board of trustees meeting when this will be held that number one, that you prefer not to make a change to the investment policy, and you discuss the issue of coming with funds, and you can talk about the direct investments. And I believe that that's the way we should go. I also believe that two things. Number one, that you should not expect that that's going to be taken into account. This is going to be passed the way it is now. And I would also tell you that this is not the hill you want to die on, because we've talked to some pension counsel, and they don't consider this a navigation of their fiduciary responsibility, because they believe it's prudent not to be investing in the Russian or Belarusian securities right now. Don't be mistaken, and I'm sure Willie will tell you this is the next round of these discussions is going to be broader. And I think that's where you want to make your case, and that's where you want to state the claim that moving into ESG or moving into whatever realm they want to move into it is problematic in terms of the fiduciary responsibility. And I think that's where you're going to want to make your stand. And William's done this several times over the past several years, and we've done it successfully. They would have liked to have made changes that they made in the general government's operating investment policy and the pension plans as well, but they were deterred by the arguments about the fiduciary responsibility. And that's another point about this particular language. I don't know if this is the final, is that it directs policy changes, which they've already done because they do that as a city commission, to the operating investment portfolio of both general governments and GRUs. We'll have to change our language specifically related to Russia and Belarusian securities.
Appreciate that. I am willing to die on this hill. I'm incensed with the potential degrading of the performance of the pension plan due to political short-term virtue signaling. I think it's very, very dangerous and a slippery slope to make these type of changes. I am 100% empathetic to the intent to voice the moral outrage of what's going on in Ukraine. And I hope that someone takes out Vladimir Putin and shoots him in the next week or so. I'm personally funding some private charities that are direct care to Ukraine, not sitting around and making a resolution. But I have great concern, and if you read further down in this resolution, it says that the General Employees Pension Plan Fund, with the sole and exclusive purpose of providing pension benefits for the members of the City of Gainesville Employees Pension Plan and their beneficiaries, neither the city nor the Board of Trustees shall authorize or permit any part of the trust fund to be diverted for purposes other than the exclusive benefit of members and their beneficiaries. And my concern is if they want to exclude Belarus, Russia, and Russia direct holdings from consideration in the pension plan forever. My next question is, well, when did they decide that they don't want any company that does business in Germany because Germany is purchasing power from Russia? I mean, I think it's a slippery slope. The whole ESG discussion is really rife with so much personal opinion of what's a good company or a bad company. And if you read the rest of the resolution, it has absolutely nothing to do with the adoption of this. So I just, frankly, I don't.
I'm sorry.
Looking at other decisions that the city commissioners have made, I just have very little confidence in their judgment. And again, I'm annoyed that they're trying to make some short-term political points.
Mr. Chair, I understand, and believe me, you and I have been down this road together a number of times. I understand and I agree, but I want you to understand that when they call staff to the lectern, they ask them the question, does this violate our fiduciary responsibility? Our answer is going to be no, because specific to Russia and Belarus, we've spoken to Mr. Klausner. He was very clear. They do not consider this an abrogation of fiduciary responsibility, because no prudent investor would be making investments in that sector right now.
And I concur, and it's clear that when we look at the current holdings of our two international managers, that they have exercised that fiduciary responsibility judiciously. And so what's the point?
Well, I know this is being recorded, but I'm going to say this anyway. I have very vigorously made that point with the particular commissioner who brought this to the fore. My argument to him was, you're going to get where you want to be anyway. Our managers are putting you there. Let them manage. We don't want to tie their hands. We don't want to limit their flexibility. And the point is that there's no visceral gain to doing it that way from his standpoint. And so the passion with which you just expressed that, I think is valid. I think that you should make that point when and if they take the next step, not here, because you're not going to get any backing from pension council.
Yep.
Staff is going to have to respond in the manner in which council has, determined for us. And so I'll leave that to you, but I think your bullets are best spent when they broaden this discussion, because they will inevitably broaden it. And as William can tell you, when this item came up in front of the commission at the last meeting, people called in saying, well, we think this is great, but it's not going far enough. What about the military-industrial complex? What about, because it's going to come, and that is where they have crossed that bright line for their fiduciary responsibility.
Well, and I've read some legal, again, they have not operated legal in bad faith or with malicious purpose, or what in their willful disregard of human rights or safety of property, which is what the Florida sovereign did. But
And the city attorney put that language that you just read in there specifically so he would soften the ground for the discussion that's going to come. The commission did not want that quoted language in that resolution, but he felt like that was his duty. He knows this discussion's coming. He's softening the ground. He's expecting this type of discussion from staff and from the advisory board, but I don't know that at the next board of trustees meeting is the time to do that. But that's your prerogative.
And I appreciate your counsel, and I realize, again, it's, unfortunately, being stupid is not a criminal act, and that's exactly what we're doing right now. So,
Mr. Chairman,
yes, sir.
I just want to go on record supporting most of what you said. I'm not sure about the shooting part, but I certainly think this is a slippery slope we ought not to begin to go down. And I'd like us not to do this. I'd like you to see what you could do to get the members of the commission to understand that.
Well, when we're an advisory board to the trustees who are clearly disregarding staff advice and are going down a path that I don't think is wise for the long-term benefit of all the pensioners here. The only thing we can do is recommend. We have no fiduciary liability or power for the pension. But if somebody would like to offer a resolution that we disagree with the recent city.
We used to call this, John, political risk.
Yeah.
And what I think's being said in sort of a perverse way is the political risk associated with Russia and Belarus doesn't warrant investment at this time. And I think our international advisors would agree with that and logically wouldn't be investing.
For the good of the group, I've had this conversation with John and William. This issue in a different form came up about 10 or 15 years ago, more specifically relating to police and fire plans. About the state came out with a prohibited securities list of companies that did business in Sudan and Iran. And it essentially said if you want to continue with your state money, you as local plans cannot invest in this list that we're going to publish every quarter. And but in that language, in the law that was ultimately passed, there was a sort of an out that if you were getting exposure to those companies, you had exposure that was through a commingled or mutual fund vehicle, and that particular fund company didn't offer a similar fund that specifically excluded those prohibited securities, you were permitted to continue to own them. And so in this particular situation, from my standpoint, I understand the desire to put something like that in there, but what happens is you end up tying your hands to the extent that you have fund investments.
Right.
With separate account managers, it's easy because they're doing your account separate from the others. You can make a direct request and say you can't own these securities and it's not a problem. But in the fund situation, it potentially is. Now, it isn't currently, but if they wanted to buy something 6 months from now or 12 months from now, you'd be in a position where you'd have to remove that fund from your lineup.
So we'd have to fire two very capable managers. And my understanding is staff has expressed that or explained that to
We explained it in the finance subcommittee. We didn't really discuss it with the full commission, but I think we'll try to have that discussion when this item goes to the Board of Trustees, and maybe even recommend that they adopt similar language that the state did, so that it allows for indirect commingled fund investments. Mark's probably got a better read on the commissioners than I do, but they seem pretty adamant about this, so I'm not sure that we could expect them to accept that.
I think you should, well, that's what I'm about to
No,
say.
no,
You should
no,
resign yourself to the fact this is going to be passed in the manner which is treated now. I do think that we will have the conversation about commingled funds and other language at the Board of Trustees. We didn't do it at the commission level because the commission has no power. The commission, sitting as the commission, has no power to make that change. That's why it's drafted in the manner which it's drafted. It goes to them sitting as the Board of Trustees, and we'll have that discussion when it comes to it. I'm not, actually, once they pass this, we probably have a better chance of going back and amending the language. Once it's passed, understand that this is a political
Of course it is.
statement. So when they pass this, then we'll have a better chance of going back and crafting changes around the edges, because we've gotten the headlines and we've gotten out there, and then we can craft that to make a change.
But as a group, we need to take the position that we find this to be not a good idea, and we need to go on record saying that. I so moved.
I have a motion, do I have a second?
He can probably make a motion, but he can't vote on it. Dave, because we don't have an affidavit from you, you know, I think you can participate in the discussion. It would probably be better if someone else made the motion, and I don't think that David can vote on it because we don't have the affidavit of extraordinary
I think you're right.
circumstances.
Well, let me, before we proceed, and I appreciate Dave, again, you can tell I feel very strongly about that, and it's not this particular resolution per se, it is what I think is going to be potential future meddling in the political sense to what's been a very, very well-managed fund, and we've done very well because we've avoided the political foolishness over the last 20 years that I've been involved. So that's where I'm so incensed about this short-term decision by a couple of politicals. Having said that, my passion, we're a board here, so I'm kind of curious. I like each board, but what's your thought on that? Am I, you know, as a board, we don't have the same mind, then I don't think we need to be making a resolution, as much as I'd like
I
us
think
to.
it's a slippery slope. Who's next, McDonald's and Coke?
Yeah. Right.
You know, and that's my concern.
Mhm.
And, you know, it's evidently forever.
Mhm.
But I think that if it's not a problem right now, I think Mark can.
I don't know that the intent is for it to be forever. It doesn't
An
specify
ordinance
it.
is forever.
I'm sorry?
An ordinance is forever.
Well, no,
If they go-
a resolution can be terminated. It can be, rescinded. So just because they pass this resolution now, they can rescind it at a future date if there's some sort of settlement agreement or regime change or something like that. This isn't permanent.
It's in effect until it's amended.
Yeah. So
It can be
I mean,
amended though, too.
right. I might recommend that, it really is up to the committee to determine how you want to proceed. I think that if you do decide to make a recommendation to the city commission or actually to the board of trustees, that it would probably be in the form of you directing staff to draft a memo on your behalf or something to that effect. And that could go to the city commission as backup along with this item, I think. Mark, would that be reasonable if that's what the committee chooses to do?
I think that's fine, and I think that's fine. I also think it's fine if you want to, make a statement as a board that you don't agree with this. I'm just saying, this is not where your battle's going to be.
No, I know.
Your battle's going to be at the next one. If you as a board decide that you don't agree with this, I think you should tell them that you don't agree with it. I think it would be very beneficial if you direct staff to draft a memo making the points that William made about the commingled funds and perhaps move in some language that, such as Brendan talked about being able to, amend that and talk about direct investment and put it as backup to the agenda item.
Yeah,
I think that's fine. There's no problem with you saying, you ought to say what you feel. You want to agree with us.
My stance is, obviously, I'm in harmony with the intent of this. I'm not in harmony with how they're going about it, I guess. I don't disagree with not investing there right now. I think it's very smart. I think it's the right choice. Obviously, our managers are doing that already. I think as a board here, our job is to hire good managers that are going to do their job. I think we've effectively done that, and I think that's shown through the way they've invested the money. I'm also just in conflict with how the same people who vote to approve something can also bring it to them. And that part alone just bothers me.
That's just the structure of government.
Correct, right.
They sit as a different group because the Board of Trustees is a separate group from the City Commission.
Correct. So that part alone is just frustrating in itself. But I certainly am not in agreement with the way in which they're going about trying to achieve their goal. Again, I don't disagree with their goal currently. I just disagree with the way in which they're doing it. So I absolutely would support a motion, a memo, or whatever, to show our dissatisfaction with the steps they're taking to try and implement the restrictions that we actually already have in place through the managers we've hired. And I think maybe you can spell out a little bit of the additional cost to the plan and to the members of the pension that it would be if we had to go into a different arrangement and not use commingled funds. Because there's going to be an increased cost if we go away from that, which then obviously is going to impact directly the people who benefit from the pension plan. So I think those participants need to know that. That is a fiduciary responsibility, by the way, cost. And so you can layer this however you want, but.
That's the one thing I would suggest, respectfully, that you don't include in whatever you put together in language. Do not imply, do not assert that this resolution is in violation of the fiduciary responsibility, because
I'm not saying the resolution is, I'm just saying.
I'm just saying, don't put any language like that in there, because it's going to be rejected out of hand. The attorney, pension counsel have all already taken a position.
Yeah, no, I'm not saying the resolution is, I'm saying that the effect of the resolution by making us go away from commingled funds will then increase costs because we'll have to go a different avenue. That's not the resolution itself, so I agree there, but the cost side of things, which is a fiduciary responsibility.
Percent of the fund.
And we can
28%
probably
Absolutely.
work up some sort of an estimate. I mean, my impression is that it would be a matter of basis points. It's not a huge cost, but we could probably work up an estimate.
Basis points matter over a long period of time.
Sure, yeah, no, absolutely.
Well, my biggest concern is, frankly, the biggest risk is if we lost the ability to continue working with the Silchester or Bailey Gifford, or to high-quality managers in their space, because that's my long-term concern versus some of my longer-term concerns are just meddling in general. Having said that, I think a memo with some technical points made that we're not in favor of this full resolution. We would like to have these adjustments made, and certainly they can ignore us if they want. I'm a little bit annoyed they didn't bother to talk to us at all about this, but that's fine. That the city commission is kind of doing whatever the hell they want anyway. So.
But it might be important to emphasize the positive. The purpose is already being achieved.
Yeah.
I mean, logically this would happen because the managers would take into consideration the political risk, and there's an intense increase in the political risk associated. And the slippery slope is, sort of who's next. If you politicize this thing, is it China?
Yeah.
Okay, and there's no real reason other than, as you say, virtues.
Well, and the truth is also that selling a company's stock doesn't really impact the company. And I don't think they really understand that you're not like taking money away from the company when you sell their stock.
Yeah, you don't want to educate them on that one.
Well, again, Dave, you raised the point, again, and I appreciate everybody's, honest feedback here in what we all think agrees is less than optimal resolution. As a chairperson, I can't make a motion, so the points, it seems to me, is one, this is really not needed because our managers have already assessed the rational business risk that owning direct companies in Belarus and Russia makes no sense. So this is kind of a moot point in terms of the resolution. Second of all, if we make a resolution and that permanently restricts us, or until they rescind the resolution, it runs the risk of a capable manager taking a sound investment opportunity in Russia or Belarus sometime in the future. It means that we have to fire capable managers. And then I think the discussion about the issue of commingled funds versus direct ownership via separate manager needs to be discussed in the memo. And basically, I think that's, we can pick apart obviously what we consider the errors in this resolution.
Can you guys snooze that too? Can you guys snooze that, because you have to deal with them?
I would suggest what happens is that William drafts this, we run it through, and then we'll send it to each of you, and you guys can.
Okay, I think that makes sense.
That's what he said, that motion.
Second.
Second. All right, any more discussion? All in favor, please say aye. Aye. All right, let me note it was a unanimous vote from the committee that were able to vote. And David, appreciate your comments and participating in today's meeting remotely.
Yeah, and I respect what William was saying. I didn't think of that.
Okay, great.
We will, we'll try to get a memo drafted up this week, and I'll send it out to each of you individually so that we don't violate any sunshine issues. If you have comments, send it back. And when we have a final version, I'll just send it out to everyone, and we will work with the city manager's office to attach it as backup to the agenda item that will go to the Board of Trustees on the first Thursday in April.
Okay.
I believe that's when it will go, right, Mark?
I believe so. I believe that they are moving it along expeditiously.
And, not to encourage dissent, but there is public comment available at the city, at that meeting. So if anyone wants to...
Could you send the time and the date again? All of us are pretty busy, but if I can schedule a time, I may want to make some comments to the board.
And I don't know when they're...
There's fomenting revolution.
I don't know when they're ending the call-in.
It's going to be a $150 call, that's what I was curious about.
Has it ended officially now?
I know, I believe that they are in the process of terminating that contract.
So you may not be able to call in. You may have to show up in person.
That's fine. I prefer to show up in person anyways. If I can, so if you can send me that information, that'd be great.
If you do remember that it will not be their normal 10 o'clock start, it'll be 5 to 15 minutes ahead of them.
So they haven't met as a board with the earlier start time. Do you think they will meet, again earlier, or will they push it to the afternoon?
Normally, the start time for the city commission was 1 o'clock, and they would schedule the board, sitting as a board at 12:45.
Yeah.
So I'm assuming now that they moved to 10 o'clock, that they'll start at 9.
But we'll
find out.
make sure you
I
have
want you to show up
all the
15 minutes
information.
late.
Then the other question, just an item, I'm looking at this map, so is the red marked, is that good?
Yeah, the red.
Oh, that's good or not
The
bad.
red is
Normally red, I'm like, wow.
We wanted to use yellow, but Google already has the main
Okay, very
streets
good.
in
Okay,
yellow,
all
so.
Thank you.
But what we need from every committee member is your tag number and state and your name. You can only use it for one vehicle, so if you have multiple vehicles, just, pick the one that you intend to use. And my understanding is it's also going to be restricted to we also have to submit the committee schedule of meetings. So your ability to park this way using this system is restricted to meeting times.
That makes sense.
So,
Okay. All right.
I have something.
Harvey, yes, sir.
As to Dave's situation, do we ever turn around and have a blanket affidavit? Like when it's raining cats and dogs at my house, when I thought about what Dave was doing, I said, this would be good, but I didn't send in my paperwork.
so you can't do it. You can't do it for like multiple meetings at one time unless I guess maybe you're gonna, say be out of the country for 6 months or something, The intent was for it to be, I think, extraordinary circumstances, but if the weather is bad, I know it's hard to predict that, but if you send it in the day of the meeting, if you get up in the morning and you don't think you can, make it to the meeting because of something, you could send it to me. Now, you may not be able to get it notarized, but, and it would have to be notarized to be able to vote. But, if you can get it to us, you can still participate in the discussions and stuff.
That's another, I know that it's a policy, it's another policy I'd like to look at in case Stan Druckenmiller or Warren Buffett want to be on our board, but they can only do it remotely. I'd kind of like to be able to participate if they wanted to,
I don't know what the origin of that affidavit was, whether it came out of the former city manager's office or
So make
From
it
the
as
clerk's
difficult as
office.
possible to come to a meeting.
But it, maybe it's something that gets modified as we move forward. I'll ask the clerk's office about it and see if they have any idea of.
And I understand the need, you want to have people participating in the sunshine. I'm all for sunshine and so forth, but again, it's, they don't need our bodies here, they need our experience and minds, in my opinion. So,
Some of that goes back to, I think, Florida statute, though, about.
It does,
Yeah.
it's a longer.
Yeah.
Who do we provide the tag number and?
To me or to Greg, you can email them to me if you like, and we'll get them entered into the, so it's like an internal, a system that they use.
And it's a one-time thing?
It should be,
Okay.
unless you have a change.
Okay.
Great. All right, I take a motion to adjourn the meeting. And I second. Meeting is adjourned. Thank you, everybody.